Welcome to this insightful journey of Bursa Malaysia's Sustainability Explainer video series. For the first chapter, we will cover the introduction to Bursa Malaysia's sustainability reporting requirement. We will look into the pivotal role of sustainability in today's global and local business landscapes, as well as the key enhancements made to Bursa Malaysia's sustainability reporting framework. First and foremost, let's start by exploring key global sustainability efforts that have notably shaped the current landscape. The United Nations (UN) has embraced the ambitious 2030 Agenda for Sustainable Development, encompassing the UN Sustainable Development Goals (SDGs), addressing vital issues such as poverty, education, and gender equality, among many others. Additionally, the 2015 Paris Agreement strives to limit global temperature rise to below 2 degrees Celsius, preferably 1.5 degrees Celsius, to combat climate change. These initiatives create a collective global framework for sustainability, fostering unity among nations and organizations with shared goals. Businesses worldwide are increasingly prioritizing sustainability in their operations and strategies. This trend is propelled by factors such as acknowledging their impact on the environment and society, along with responding to heightened awareness and demand from consumers and investors. In Malaysia, the government and regulators' strong commitment to sustainable development has significantly motivated businesses to embrace sustainability practices. Companies, be it multinational or local, are redefining their business models, supply chains, and operations to contribute positively to the world. Now, let's discuss the advantages of quality disclosure. Good quality of sustainability disclosure offers numerous benefits for organizations. It does not only build trust and accountability with stakeholders but also attracts mindful investors, and reducing financial risks associated with ESG factors. Going beyond compliance, quality disclosure can internally drive operational efficiencies and reveal opportunities for innovation and growth. In the landscape of sustainability disclosure, there are various frameworks and standards that can be used as references to ensure comprehensive and standardized disclosure practices for organizations. Notable frameworks include, but are not limited to, the Global Reporting Initiative's GRI standards, Task Force on Climate-Related Financial Disclosures (TCFD), Sustainability Accounting Standards Board (SASB), and the recently released ISSB S1 and S2 standard by the International Financial Reporting Standards (IFRS). In Malaysia, companies can use regulatory-related standards and frameworks as guidance, which encompass the Malaysian Code on Corporate Governance (MCCG), Guidelines from Bank Negara Malaysia, the third edition of Bursa Malaysia Sustainability Reporting Guide, and the Illustrative Sustainability Report (ISR). While it might be overwhelming to consider all these frameworks, companies can prioritize meeting regulatory requirements and aligning with industry peers. Ultimately, companies should bear in mind that these frameworks serve a singular purpose: to collectively offer a structured approach to environmental, social, and governance (ESG) disclosures. Now, let's deep dive into the key enhancement made for the third edition of the Bursa Malaysia Sustainability Reporting Guide. On September 26, 2022, Bursa Malaysia issued an updated sustainability reporting requirement in the Main Market Listing Requirement (MMLR) and ACE Market Listing Requirements (ACE-LR). Bursa Malaysia envisions that these enhancements will not only improve the overall quality of sustainability disclosures but also foster a higher standard of sustainable practices. Moreover, these changes aim to facilitate comparability across listed issuers, encouraging the adoption of international best practices. Ultimately, the anticipated outcomes include an increased influx of funds and investments into the Malaysian capital market, signaling a positive trajectory towards a more sustainable and globally competitive business environment. To ensure a phased and manageable transition, timelines are set for both the Main Market listed issuers and ACE Market listed corporations to comply with the new requirements. This approach aims to facilitate a smooth adoption process, allowing companies to gradually incorporate the guide's enhanced requirements into their sustainability disclosure practices. The key enhancements introduced by Bursa Malaysia encompass several crucial aspects, which are sustainability disclosures, assurance, and climate-related disclosures. In terms of sustainability disclosures, a significant development involves the disclosure of 11 common sustainability matters, complete with accompanying indicators. Main market-listed issuers are required to disclose the first 9 common sustainability matters and indicators, starting from the financial year end December 31, 2023. The remaining 2 common sustainability matters and indicators are to be disclosed by financial year end December 31, 2024. Additionally, main market-listed issuers are also required to disclose 3 years of historical data, performance targets, and a summary of ESG performance data against targets as part of their sustainability statement from financial year end December 31, 2023. On the other hand, ACE market-listed corporations are expected to disclose the first 9 common sustainability matters and indicators by financial year end December 31, 2025, and the remaining 2 common sustainability matters and indicators by financial year end December 31, 2026. In terms of the disclosure for 3 years historical data, performance targets and summary of ESG performance data against targets, ACE market-listed corporations are required to disclose them by financial year end December 31, 2025. In the realm of assurance, companies are now mandated to provide a statement on whether the sustainability statement has undergone assurance. If conducted, assurance can be done either internal or external. Main market-listed issuers are required to disclose their statement of assurance by financial year end December 31, 2023. Whereas for ACE market-listed corporations, they can disclose their statement of assurance effective from financial year end December 31, 2025. Concerning climate-related disclosures, main market-listed issuers are obligated to align climate-related disclosures in the sustainability statement with the Task Force on Climate-Related Financial Disclosures (TCFD) recommendations, commencing from the financial year end December 31, 2025. Meanwhile, ACE market-listed corporations are required to disclose a basic transition plan towards a low-carbon economy by financial year end December 31, 2026. These pivotal changes emphasize Bursa Malaysia's commitment in fostering transparency, accountability, and robust sustainability practices among listed issuers. In summary, it is important for listed issuers to ensure that their disclosures are balanced, comparable, and meaningful, as it is critical in enabling stakeholders to form an objective opinion of the company's sustainability practices and disclosures. You may refer to the 3rd edition of Bursa Malaysia's Sustainability Reporting Guide and Toolkits, the Illustrative Sustainability Reporting Guide, and other referenced sustainability frameworks for detailed guidance. In the next chapter, we will be discussing on sustainability governance and scope and basis of scope, so stay tuned.
In this chapter, we will discuss the essential role of sustainability governance, as well as the scope and basis of scope in sustainability disclosures. According to the 3rd edition of Bursa Malaysia Sustainability Reporting Guide, sustainability governance structure is defined as the structure a company has in place to ensure accountability, oversight, and review in the identification and management of sustainability matters, and that includes the roles and responsibilities of those in charge of the company's sustainability performance and disclosures. At its core, sustainability governance involves strategically integrating sustainability principles into decision-making processes. For the first part of the chapter, we will focus on the oversight of sustainability matters, strategic management of sustainability matters, as well as day-to-day implementation of sustainability matters. In the 3rd edition of the Bursa Malaysia Sustainability Reporting Guide, the discussion of the oversight of sustainability matters is framed around the governing body's responsibility for overseeing the company's material sustainability matters and the nature of that oversight. Board sets the tone for embedding sustainability into the organizational culture. To demonstrate accountability, listed issuers should disclose the roles of the board in overseeing material sustainability matters. This includes but not limited to strategies, priorities, and targets. In the provided Illustrative Sustainability Report, ISR sample, it is mentioned that the Board of Directors also monitors climate-related risks and opportunities. Depending on listed issuer's structure, the board might assign oversight role to another body such as board committees. These committees are assigned specific sustainability-related roles for a more effective corporate governance. It's important to note that even if oversight role is delegated, the ultimate responsibility still rests with the board. The Malaysian regulatory frameworks stress the importance of diversity and expertise on boards, particularly in the realm of sustainability matters. The board should take appropriate actions to ensure that they stay updated with and understand the sustainability issues relevant to the company and its business, by attending capability-building programs, for instance. As per the ISR sample, the board also ensures that board competencies related to sustainability is periodically assessed to strengthen the board leadership and oversight of sustainability matters. Moving on to the strategic management of sustainability matters. Bursa Malaysia requires listed issuers to disclose the body, function, or individuals responsible for the strategic management of their material sustainability matters. This includes but not limited to formulation and evaluation of sustainability strategies, priorities, targets, and management of risks and opportunities. It is also essential for listed issuers to disclose the nature, scope, and specific role dedicated to the body, function, or individuals. In this sample, you can see that the management of sustainability matters was assigned to the Sustainability Steering Committee with specified roles and responsibilities. The specific individuals accountable for this committee and roles are also disclosed. It is recommended for the management to monitor and integrate sustainability risks and opportunities into the company's existing risk management framework as part of the strategic management of sustainability matters. Having a clear structure for the day-to-day implementation of sustainability efforts is vital to align with the company's sustainability goals and objectives. According to the third edition of the Bursa Malaysia Sustainability Reporting Guide, listed issuers should disclose the functions or individuals who are responsible for, or tasked with, the day-to-day implementation of sustainability-related plans, tasks, and initiatives. Using the sample taken from the ISR, the listed issuer disclosed that it has a dedicated function called the Sustainability Working Group, represented by middle managers from different functions, to carry out the daily implementation and operations of the company's strategies and plans related to sustainability. For more real-life examples on day-to-day sustainability routine, listed issuers may refer to the third edition of the Bursa Malaysia Sustainability Reporting Guide, as well as the Toolkit Governance. Before we conclude our discussion on sustainability governance, it is important to note that the development of sustainability governance structures is an evolutionary process requiring significant time and commitment. Bursa Malaysia anticipates a maturation of sustainability governance disclosures over time from listed issuers. Lastly, it is crucial to reiterate that there is no one-size-fits-all for sustainability governance structures. Each listed issuer's governance structure is distinctive, shaped by its own unique structure and available resources. However, at a minimum, listed issuers should consider disclosing a clear structure and sustainability-related roles for board, management, and day-to-day functions. Now, we have reached the second part of this chapter, which is the scope and basis of the scope. According to the third edition of the Bursa Malaysia Sustainability Reporting Guide, scope refers to the extent or the coverage of data and information reported in the company's sustainability statement. The term boundary may be included in the disclosures of scope. Meanwhile, the basis of scope refers to the justification, explanation, and context related to the company's reporting scope, covering exclusions and expansions that occurred during the company's reporting period. There are basically three types of scope. First, geographical locations of operations, simply known as geographical boundary. This refers to the physical or operational locations of the business. When describing the scope of the sustainability statement along this dimension, companies may opt for specific geographical points of interest or priority if they are unable to cover all operations. Secondly, entities controlled by the company, which is also known as organizational boundary. The scope of the sustainability statement is described in terms of the entities controlled by the company. Some companies may opt for specific entities or assets of interest or priority if they are unable to cover all operations. Thirdly, business segments or divisions. For companies operating across various industries, sectors, or product lines, the scope of their sustainability statements may be described along the business segments dimension. Some companies may opt for specific business segments of interest or priority if they are unable to cover all operations. It is important to note that Bursa Malaysia expects listed issuers to cover all, or eventually cover all of its operations to better conceptualize the footprint of the listed issuer's operations. For advanced disclosure, mature listed issuer can consider providing information about its operations within the value chain, which includes procurement, product manufacturing, end of life, and after-sales phases. The value chain is further defined as upstream, midstream, and downstream. Disclosing value chain in the scope shows readers that the listed issuer understands the impacts of its activities and reinforces its dedication to integrating sustainability into its operations. As for the basis of scope, listed issuers must disclose why or how it chose the boundaries. A clear basis for the scope is necessary unless the sustainability statement already includes all segments, entities, or operations under the company's control. If the reporting scope doesn't cover all operations, listed issuer should clearly explain what's included or excluded and provide reasons for these choices. Let's take a look at our example here. The listed issuer has explicitly mentioned up front that they have excluded few entities due to a recent acquisition and their insignificant sizes, and they even mentioned their plan for future inclusion. To summarize key points from this chapter, in terms of sustainability governance, listed issuers are required to disclose the oversight of sustainability matters, the management of sustainability matters, and the day-to-day implementation of sustainability matters. The sustainability governance structure should also be supplemented with specific roles and responsibilities. As for the scope and basis of scope, listed issuers are required to clearly mention the boundary of their sustainability statement and provide a clear justification for why and how they chose the boundary. By disclosing all the required aspects discussed in this chapter, you're one step forward towards ensuring your company meets the Bursa Malaysia listing requirements. Listed issuers may refer to the third edition of the Bursa Malaysia Sustainability Reporting Guide, Illustrative Sustainability Report, Toolkit Governance, as well as the PLC Transformation Program Guidebook 2 for more guidance related to sustainability governance and scope and basis of scope. We will be discussing materiality assessment in our next chapter. See you there. We are now at Chapter 3, Materiality Assessment. In this chapter, we will delve into the critical process of identifying, prioritizing, and reviewing sustainability matters for effective disclosure. As organizations navigate the evolving landscape of sustainability reporting, understanding materiality assessment is vital. This process typically comprises 3 distinctive phases. Phase 1 involves the identification of sustainability matters, followed by Phase 2, which focuses on the prioritization of material sustainability matters, and finally, Phase 3, which involves the review and validation of process and outcome. Let's start by examining how listed issuers identify and define sustainability matters relevant to their operations. In Phase 1, a company should begin by developing an understanding of its distinctive operating context, gaining broad knowledge of sustainability matters and issues, both internal and external, that could impact its ability to achieve intended business goals and outcomes. In identifying relevant sustainability matters, the listed issuer should leverage a myriad of sources to enhance the comprehensiveness of the identification process. These sources include internal and external stakeholders, business strategy, goals, objectives and policies, Bursa Malaysia's listing requirements, and the guide, among others. Among these sources, stakeholder engagement stands out as particularly critical. The company is expected to engage with both internal and external stakeholders to better identify sustainability risks and opportunities. Typically, there are 2 common approaches in identifying sustainability matters. In the first approach, identification is integrated into general stakeholder engagements conducted throughout the year. These engagements cover all relevant issues, not exclusively focusing on sustainability matters. In the second approach, identification of sustainability matters occurs through a series of stakeholder engagements specifically designed for this purpose. These engagements are part of the overall materiality assessment process and go beyond general stakeholder engagements conducted throughout the year. The stakeholder engagement process begins by identifying the company's key stakeholders and understanding their needs and expectations regarding the company's sustainability-related impacts. The identification phase should result in the listed issuer deriving a preliminary list of sustainability matters. Recognizing that not all sustainability matters carry equal weight, the next crucial phase, which is phase 2, is to prioritize them based on their relative importance, essentially their degree of materiality in relation to one another. This prioritization aims to streamline the company's efforts and allocate resources to its material sustainability matters, focusing on what truly matters most to the organization. In determining the degree of materiality, two primary considerations come into play: the significance or magnitude of their respective impacts and their influence on the assessments and decisions of stakeholders. Therefore, stakeholder engagement becomes a pivotal aspect of the prioritization process for identified material matters. As listed issuers navigate this process, there are two commonly adopted approaches. In one scenario, sustainability matters are identified through general stakeholder engagements throughout the year, with an additional series of engagements dedicated solely to prioritizing material sustainability matters. Another scenario is when sustainability matters are identified through specific stakeholder engagements as part of the overall materiality assessment process. These engagements should also encompass the prioritization of identified sustainability matters. Subsequently, the priorities of each stakeholder group are carefully considered and assigned varying weightages. The weightage assigned to each group depends on factors such as their interest in and influence on the company. This prioritization of stakeholders is crucial, as it indicates the significance or importance of a stakeholder group to the organization. This understanding allows the organization to gauge how a sustainability matter may be deemed material. Once the material matters are prioritized, it is recommended for listed issuers to disclose a materiality matrix to clearly illustrate the relative importance of each matter, an outcome of the materiality assessment process undertaken. For instance, listed issuers could demonstrate relative importance by sorting material matters into high, medium, and low categories. Alternatively, listed issuers could establish a materiality threshold, considering all material matters above the preset level sufficiently material to be managed and reported. Some real-life examples from companies' sustainability reports can be referred to in our third edition of the Sustainability Reporting Guide. Validation is crucial. In the final phase of the materiality assessment process, it is imperative to review and approve both the process and outcome. The company's senior management typically oversees this stage. In addition, the company's board shall approve, validate, or endorse the outcome as they bear the responsibility for the disclosed information. The direct involvement of these stakeholders ensures widespread support across the company, facilitating resource allocation and accountability for managing such matters. Conducting a process review is also beneficial in identifying any gaps or weaknesses and exploring opportunities to enhance the robustness of future assessments. Once the material sustainability matters have been determined, the listed issuer should periodically revisit them to ensure that recent developments and changes have been considered and incorporated. Conventionally, a listed issuer should review its material sustainability matters at least annually. In this regard, the listed issuer could either opt to conduct a full-scale materiality assessment or a limited-scale review. For the first option, this involves undergoing the full assessment process, as detailed throughout this chapter. As this exercise requires considerable commitment of time, resources, and effort, some companies undertake this on a predetermined frequency, for example, at least once every 3 years. Regardless of whether a company has general frequency criteria put in place or otherwise, the listed issuer should undertake a full-scale materiality assessment if there are major changes to its business model or operating context. Under certain circumstances, the listed issuer might opt for a more limited-scale review of its material sustainability matters. This could happen after a full-scale materiality assessment in the previous reporting cycle when there are no major changes to its business model or operating context. For instance, the review may involve surveying a smaller sample or subset of stakeholders to reaffirm that key issues remain relevant, as well as obtaining some indication of new or emerging issues. And now, let's address some frequently asked questions. The first question is there a detailed explanation of the steps to conduct prioritization matters? To briefly recap, Companies should engage relevant stakeholders to determine the importance of each material matter. Each stakeholder group is assigned differing weightages. For additional information on stakeholder engagement and materiality assessment, listed issuers are advised to refer to our third edition of the Sustainability Reporting Guide and Toolkits, and the Illustrative Sustainability Report, all of which are publicly available on Bursa Sustain. Secondly, we often receive inquiries about whether listed issuers are expected to follow the material matters listed in the Common Sustainability Matters, and if they can add their respective material matters. Sustainability matters are considered material if they reflect the listed issuer's significant economic, environmental, and social impacts, or substantively influence the assessments and decisions of stakeholders, and fall under the common material sustainability matters as set out in Practice Note 9 for Main Market, or Guidance Note 11 for ACE Market. Additionally, listed issuers are required to disclose the 11 common sustainability matters with accompanying indicators. Main market listed issuers are required to disclose the first 9 common sustainability matters and indicators, starting from the financial year end 31st December 2023, and the remaining 2 common sustainability matters and indicators, waste management and emissions management, which should be disclosed by financial year end 31st December 2024. For ACE market-listed corporations, the first 9 common sustainability matters and indicators should be disclosed by financial year-end 31st December 2025, and the remaining 2 should be disclosed by financial year-end 31st December 2026. Lastly, there are also concerns about whether listed issuers are expected to cover sector-specific matters or if they can add their respective material matters. Please note that listed issuers are accorded the flexibility to adopt any non-mandatory indicator where applicable according to the nature of their business operations. As we wrap up, let's summarize the key takeaways. The materiality assessment process enhances transparency and accountability. It typically consists of 3 phases: identification of sustainability matters, prioritization of material sustainability matters, and the review and validation of process and outcome. The senior management and the board of the company shall bear the ultimate responsibility for the outcome, and companies should strive to periodically revisit their material sustainability matters. Lastly, we encourage companies to continually improve their sustainability reporting practices in line with Bursa's market listing requirements. In the next chapter, we will be covering how companies can manage each of the material sustainability matters that they have prioritized via their materiality assessment process. We are now at Chapter 4, Management Approach. As discussed in the previous chapter, materiality serves as the foundation for our exploration of managing sustainability matters and reporting on relevant indicators. In this chapter, we'll navigate through how listed issuers can efficiently manage identified material sustainability matters, report on relevant indicators, and adhere to data provision requirements. Listed issuers should strive to effectively manage their material sustainability matters by aligning with established management approaches, processes, and relevant international standards. This alignment can be achieved by implementing group-wide policies and strategies that address material matters impacting the entire company operations. Moreover, the management of material matters is often guided by local legislation, such as the Malaysian Anti-Corruption Commission, MACC, Act 2009, and Personal Data Protection Act, PDPA, 2010, as well as international standards like the Occupational Health and Safety Act, 1994. Disclosures regarding a listed issuer's management approach for each reported material matter should encompass several key components. This includes the establishment and implementation of policies and procedures, the adoption of management system standards and frameworks, action plans, initiatives, and/or completed, ongoing, or planned measures. Listed issuers should illustrate how each matter is managed and provide sufficient context to aid readers understand the relevance of reported indicators within the listed issuer's operating context. Additionally, the disclosure should outline performance targets related to the indicators, along with specific timeframes for achievement. Any changes or revisions to a performance target committed should be adequately justified. Furthermore, Listed issuers should communicate the implications of their material sustainability matters, such as risks and opportunities, on overall business strategy and financial performance. This aids in conveying the effectiveness of the management approach to key stakeholders. At a minimum, listed issuers should develop policies for material sustainability matters where regulatory requirements apply, such as anti-bribery and occupational health and safety policies, and then progressively for all other sustainability matters. More advanced listed issuers, however, should aim to integrate sustainability policies within the listed issuer's business strategy. For instance, this could involve policies related to phasing out the financing of coal for financial institutions. Similar attention should be given to the procedures or action plans implemented for managing material matters. Listed issuers in the early stages of their sustainability journey may have standalone initiatives that are not linked to business strategy. They can then progressively include key action plans linked to key sustainability targets. In contrast, more advanced listed issuers embed relevant processes into their daily operations. Reporting on relevant indicators is crucial for communicating a listed issuer's progress, effectiveness, or efficiency in managing its materiality sustainability matters. There are two types of indicators: absolute and intensity indicators. Absolute indicators have units of measurement in absolute terms, while intensity indicators are measured relative to the company-chosen metric. When adopting and reporting relevant indicators, listed issuers should, at a minimum, include all common indicators identified by Bursa Malaysia. Additionally, listed issuers can also incorporate relevant sector-specific indicators, those prescribed by international reporting frameworks and standards, and benchmark against indicators disclosed by their peers. The disclosure of these indicators should be clear in terms of the boundaries of what is being included and excluded. An example shown here is of how a company can disclose their total GHG emissions. Companies can also refer to the third edition of our Sustainability Reporting Guide for real-life examples. For each reported indicator, listed issuers should provide 3 financial years' worth of data. This enables stakeholders to assess the company performance more effectively. In cases where a sustainability indicator is reported for the first time, the data should be disclosed on a rolling basis for the second and third year of reporting. Additionally, listed issuers should strive to disclose historical data from the time when the related indicators were first reported. Examples of provision of data can be referred to in our illustrative sustainability report for some of the material matters as shown here. And now let's address a frequently asked question when it comes to management approach. Can listed issuers report on certain common indicators earlier than the given timeline, such as emissions management and waste management, to be reported on or after financial year end 31st December 2024? As mandated, the specified timeline serves as the bare minimum for companies to adopt these indicators as part of their disclosures in stages. In this case, main market listed issuers shall disclose these indicators by financial year end 31st December 2024, whereas ACE market listed corporations are required to do so by financial year end 31st December 2026. However, we encourage companies to disclose these indicators earlier, if they can. As we conclude this chapter, let's summarize the key takeaways. Managing material sustainability matters is not just a requirement, it's a strategic approach aligned with the overall materiality assessment process. Listed issuers should disclose how they manage their material sustainability matters, whether through policies, management standards, frameworks, etc. Additionally, it's crucial to disclose the relevant indicators for identified material matters along with their performance targets. These disclosures should encompass, at minimum, a 3-year historical data set. Integrating these practices into your sustainability disclosure enhances transparency and ensures compliance with Bursa Malaysia's requirements. In the next chapter, we will be discussing some of the measurement methodologies for the disclosed indicators. In this chapter titled Measurement Methodologies for Indicators, we will explore both common and sector-specific sustainability matters and indicators, along with measurement methodologies for these indicators. In the third edition of the Bursa Malaysia Sustainability Reporting Guide, 2 categories of material sustainability matters were introduced, which are common and sector-specific sustainability matters. So, what do common and sector-specific sustainability matters actually mean? Common sustainability matters refer to sustainability matters deemed material for all listed issuers, regardless of their size and sector. In total, there are 11 common sustainability matters that listed issuers should disclose, which encompass anti-corruption, community society, diversity, energy management, health and safety, labor practices and standards, supply chain management, data privacy and security, water, waste management, and emissions management. Each common sustainability matter has its own set of indicators. Taking anti-corruption as an example, Bursa Malaysia has outlined 3 common indicators tied to anti-corruption that listed issuers are mandated to disclose. For each disclosed sustainability matter and indicators, listed issuers must provide an adequate explanation to aid readers in understanding the relevance of the sustainability matters to the company's operating context, as well as the underlying reasons for key changes or trends observed. In the Illustrative Sustainability Report, ISR, you can find various samples demonstrating how listed issuers can effectively disclose these common sustainability matters and indicators in their sustainability statement. As previously mentioned in Chapter 1 of this video series, there are specific timelines on when main market listed issuers and ACE market listed corporations are required to disclose the common sustainability matters and indicators. Please refer to Chapter 1 Introduction to Bursa Malaysia's Sustainability Reporting Requirement, the 3rd edition of Bursa Malaysia Sustainability Reporting Guide, and the ISR for further guidance. Moving on to sector-specific sustainability matters. Sector-specific sustainability matters refers to sustainability matters deemed to be material to specific sectors. There are a total of 8 sector-specific sustainability matters listed in the guide, covering biodiversity, community or society, customer health and safety or product responsibility, emissions, which is air quality or pollution, materials, supply chain, environmental, or supplier environmental assessment, supply chain social, or supplier social assessment, and lastly, effluents. These sector-specific indicators are tailored to specific industries such as construction, energy, plantation, property, utilities, consumer products and services, industrial products and services, transportation and logistics, healthcare and rates. Just like the common sustainability matters, each sector-specific sustainability matter is accompanied by its own set of indicators. For instance, biodiversity is a sector-specific sustainability matter applicable to sectors such as construction, energy, plantation, property, and utilities. Therefore, listed issuers belonging to these industries can consider disclosing the associated sector-specific indicators. In contrast to the mandatory common sustainability matters and indicators, listed issuers have the option to disclose sector-specific sustainability matters and indicators on a voluntary basis. Despite this, Bursa Malaysia highly encourages relevant industries to consider these sector-specific indicators in their disclosures. In this sample taken from the ISR, the listed issuer, which is a property and IT company, has identified materials as one of its sustainability matters and has disclosed the recommended sector-specific indicators in its sustainability statement. To better aid listed issuers, especially the early reporters, the 3rd edition of the Bursa Malaysia Sustainability Reporting Guide includes methodologies for measuring both common and sector-specific indicators. Bursa Malaysia recommends the use of similar methodologies listed in the 3rd edition of the Bursa Malaysia Sustainability Reporting Guide, as these methodologies are aligned with criteria and methodologies commonly found in leading standards such as GRI standards, SASB, and FTSE. The listed methodologies come complete with descriptions, units of measurement, methodology, sources, and additional references to help listed issuers navigate and understand them more easily. For any extra indicators that listed issuers wish to disclose, it's recommended that the listed issuers adopt measurement methodologies suggested by global sustainability reporting frameworks like GRI standards, SASB, FTSE, TCFD, ISSB, and European Financial Reporting Advisory Group. It's important to note that the methodologies outlined in the 3rd edition of the Bursa Malaysia Sustainability Reporting Guide focused on absolute measurement rather than intensity-based measurement. Should a listed issuer opt to disclose intensity-based measurements, they can derive them from the absolute measurements provided. Listed issuers have the flexibility in reporting additional intensity indicators that align with their distinctive operating context, recognizing that diverse stakeholder groups may have varying interests in different intensity-based indicators. And now, let's address a frequently asked question when it comes to measurement methodologies. Can listed issuers use different set of measurement unit for the common sustainability matters? Yes, listed issuers have the flexibility to collect data using their preferred units and measurements. However, it is important to note that the disclosed data in the sustainability statement should adhere to the methodologies and unit of measurement prescribed in the third edition of the Bursa Malaysia Sustainability Reporting Guide, as these methodologies and units of measurements have already aligned with international frameworks and standards. In conclusion, listed issuers are mandated to disclose 11 common sustainability matters and indicators according to the specified timeline. Although the disclosure of sector-specific sustainability matters and indicators is voluntary, listed issuers in applicable sectors are highly recommended to disclose these indicators. In terms of methodologies, it is advisable for listed issuers to refer to the methodologies provided in the third edition of the Bursa Malaysia Sustainability Reporting Guide to ensure accurate and standardized measurement of both common and sector-specific indicators. By disclosing all the aspects mentioned in this chapter, listed issuers demonstrate their compliance with the Bursa Malaysia listing requirements. For further guidance, please refer to the third edition of the Bursa Malaysia Sustainability Reporting Guide and Illustrative Sustainability Report. See you in the next chapter where we will be discussing on performance targets and performance data table. In this chapter, we will discuss performance targets and performance data table. Performance targets are crucial as they provide stakeholders with insights into the listed issuer's goals, strategic direction, and progress in regards to the management of their material sustainability issues. On the other hand, the performance data table offers stakeholders a better understanding of the listed issuer's trends and performance over the years. Without further ado, let's jump straight into the performance targets. Bursa Malaysia highly recommends that listed issuers establish and disclose clear performance targets for their material sustainability matters, when applicable. These targets can be either qualitative or quantitative. Qualitative targets are defined as targets that describe desired states in the future, typically expressed in terms of a general commitment to improve, but with no accompanying quantitative yardstick provided. While quantitative targets refer to targets that describe desired states in the future, expressed in measurable terms, quantitative targets with clear measures and timelines are considered more credible and robust compared to qualitative targets. In this performance scorecard sample extracted from the Illustrative Sustainability Report, ISR, the listed issuer has established and disclosed both qualitative and quantitative targets, such as to increase participation of women in leadership roles by 22% and to reduce water consumption by 15% by year 2025. Once a listed issuer establishes performance targets, it is important for them to actively monitor and transparently disclose the progress made toward these targets. Acknowledging the dynamic nature of the sustainability realm, Bursa Malaysia understands that listed issuers might face challenges in meeting the set targets. In cases where listed issuers encounter obstacles that hinder them from achieving these targets on time, listed issuers should transparently disclose the actions taken to address challenges, outline their plan to get back on track, and disclose recovery plans. If any of the set targets are revised, listed issuers are expected to disclose the revised targets and provide reasons and basis for the revisions. It is crucial for listed issuers to remember that while they can revise their targets and explain the actions taken to tackle the setbacks, they should earnestly strive to achieve the set targets. Using the same sample that we used previously, the listed issuer is being transparent by disclosing that they were unable to meet some of their targets for that particular year, and have disclosed how they reviewed their current practices to ensure the targets are met next year. The listed issuer also disclosed that they fell short of meeting their waste target, which eventually led to the revision of their waste target. The listed issuer disclosed the challenges experienced that hindered them from meeting the initial targets, and the actions taken to get them back on track to achieve the revised targets. Lastly, the listed issuer also restated another target, but this is due to their positive performance. For their water target, the listed issuer realized that they are already ahead of their targets. Hence, they decided to increase the quantitative targets for their water consumption. To increase accountability and encourage better sustainability practices, Bursa Malaysia recommends linking the remuneration of boards and senior management to sustainability performance. Compensation should be tied to specific sustainability-linked key performance indicators, KPIs, within the performance evaluation scorecard. Additionally, the Malaysian Code on Corporate Governance, MCCG, recommends that boards should take into consideration the listed issuer's performance in managing material sustainability risks and opportunities when determining remuneration for directors and senior management. Doing so indicates that sustainability is fully integrated into the listed issuer's decision-making processes. For more real-life examples and case studies regarding progress against targets and on how board and senior management remuneration is connected to the company's sustainability performance, listed issuers can refer to the third edition of Bursa Malaysia Sustainability Reporting Guide, Toolkit Governance, and the Illustrative Sustainability Report. At the end of a listed issuer's sustainability statement, listed issuers must disclose a performance data table in a prescribed format summarizing data for all reported indicators and performance targets. Listed issuers are required to disclose the performance data for reported indicators in the following manner. Listed issuers are required to provide 3 financial years' worth of data for each indicator reported in the sustainability statement. For a new indicator being reported for the first time, listed issuers are required to disclose the data for that particular financial year at a minimum. In the second year of reporting the indicator, companies should have disclosed at least 2 financial years' worth of data. By the third year of reporting the indicator, listed issuers would have provided 3 financial years' worth of data to comply with the requirement. In December 2023, Bursa Malaysia introduced the ESG reporting platform, serving as a repository for disclosures and data, conforming to the prescribed format mandated by Bursa Malaysia's enhanced sustainability reporting requirements and the listing requirements. Listed issuers are required to log into the ESG reporting platform via Bursa Link to complete the template accurately in order to generate a summary performance table in PDF format. User guides and videos are also available to assist listed issuers in navigating the ESG reporting platform's functionalities. The performance table in PDF format must then be disclosed in the listed issuer's sustainability statement for announcement to Bursa Malaysia, together with the listed issuer's annual report. This example here from the ISR provides visual representation of the performance data table. And now let's address a few frequently asked questions when it comes to performance targets and performance data table. Firstly, does every indicator require a target? No. Although it is not mandatory to have targets for every indicator, listed issuers should strive to set targets wherever relevant to indicate commitments in managing material sustainability matters. Secondly, how should listed issuers present their performance data for indicators with unavailable data? Regardless of the availability of data, the format of the performance data shall follow the summary performance data table generated through the ESG reporting platform. Please refer to the ISR for more guidance on the performance data table format. Lastly, should listed issuers disclose their performance data as part of the narratives in the Management of Material Sustainability Matters section, or should they disclose it only in the performance data table section at the end of the sustainability statement? Listed issuers have the flexibility of discussing and disclosing performance data in the narratives of Management of Material Sustainability Matters. However, to meet the Bursa Malaysia listing requirements, listed issuers would still have to present the performance data in the dedicated section according to the prescribed table format. To conclude this chapter, listed issuers must recognize the importance of establishing targets for material sustainability matters whenever applicable. Following this, listed issuers should monitor and disclose progress against performance targets which, in certain situations, may lead to the revision of targets due to specific challenges. It is also crucial for listed issuers to understand how sustainability-linked KPIs and remuneration could promote better accountability related to sustainability matters. Additionally, listed issuers should disclose their performance data with progress against targets in a prescribed format to enhance comparability for readers. By addressing all these aspects mentioned in this chapter, companies effectively comply with Bursa Malaysia listing requirements. Please refer to the third edition of Bursa Malaysia Sustainability Reporting Guide and the illustrative Sustainability Report for further guidance. In the next chapter, we will be discussing assurance, so stay tuned. We have now reached Chapter 7, Statement of Assurance. In this chapter, we'll explore the critical aspects of assurance in the context of sustainability disclosures. As we delve into this topic, let's understand the two dimensions of assurance: reasonable versus limited assurance. Reasonable assurance involves the assurance provider minimizing engagement risk to an acceptable low level. This forms the basis for their conclusion, expressed as an opinion on the measurement or evaluation of the subject matter against criteria. On the other hand, limited assurance is when the assurance provider accepts a higher level of risk compared to reasonable assurance engagements. The procedures in limited assurance are less extensive than in reasonable assurance, but still aim to obtain a level of assurance considered meaningful by the assurance provider. Now let's compare internal review by an internal auditor versus independent assurance. Firstly, it's important to note that having internal and/or independent assurance is vital for enhancing transparency pertaining to the credibility of sustainability disclosures. Listed issuers should consider subjecting their sustainability statements to an assurance process as they mature in their sustainability practices and data collection processes. An internal review would be undertaken by the listed issuer's internal audit function, while independent assurance involves engaging third-party professionals to provide an external opinion on the subject matter being assured. Ideally, listed issuers should start with an internal review of their sustainability statement. Once they are more comfortable, key indicators that are considered material to the listed issuer or its stakeholder should undergo independent assurance. Finally, as listed issuers advance in their reporting journey, they should subject their entire sustainability statement to an independent assurance process. This ensures that the disclosures made within the sustainability statement are accurate and complete. Next, it is important for listed issuers to disclose the coverage of their sustainability statement subjected to assurance. While there are currently no mandatory requirements for subjecting sustainability statements to an assurance process, listed issuers should strive to do so as a best practice. However, listed issuers are required to include a statement of assurance affirming whether their sustainability statement has been subjected to an assurance process. This enhances transparency regarding the credibility of their sustainability statements. As mentioned earlier, listed issuers are highly encouraged to subject their complete sustainability statement to an assurance process over time. Lastly, let's discuss the disclosures pertaining to the statement of assurance. In the event that the sustainability statement has not undergone an assurance process, the listed issuer only needs to provide a statement to that effect. However, if a listed issuer's sustainability statement has been subject to an assurance process, the listed issuer must then disclose key areas, including the type of assurance, subject matter, and the scope of the assurance process. Firstly, it is important to disclose whether the sustainability statement underwent an internal review by the listed issuer's internal auditor and/or an independent assurance following recognized assurance standards. Next, the identification of narratives or information in the sustainability statement subject to assurance is crucial. This involves ensuring that the subject matter is identifiable and capable of consistent evaluation or measurement. Additionally, there should be enough information or procedures to gather sufficient and appropriate evidence supporting a reasonable assurance or limited assurance conclusion as deemed appropriate. Lastly, the boundary of the subject matter covered in the assurance process should be disclosed. For independent assurance, a conclusion by the assurance provider must also be disclosed within the statement of assurance. As shown on the screen, we have illustrated how a listed issuer can subject parts of their sustainability statement to internal review and independent assurance. For more guidance on different approaches taken for a listed issuer's assurance process, please refer to our third edition of the Sustainability Reporting Guide, where we explore various scenarios. And now, let's address some frequently asked questions to clarify common concerns. The first question is the statement of assurance mandatory for all listed issuers? As mentioned earlier, disclosure of the statement of assurance is mandatory for all listed issuers. However, undergoing an assurance process, whether internal review or independent, is not mandatory but strongly recommended as a matter of best practice. Following that, we have also received inquiries on whether is it a requirement to subject the entire sustainability statement to an assurance process? If not, what aspects should be subjected to assurance? We discussed earlier that listed issuers should strive to eventually subject their entire sustainability statement to an independent assurance process. However, depending on the listed issuer's maturity in reporting, they should begin with an internal review of entire sustainability statement and then progress to external assurance for certain key indicators first before undertaking an independent review for the entire sustainability statement. For main market listed issuers, the statement of assurance is mandated to be disclosed by financial year-end 31st December 2023. Meanwhile, ACE market listed corporations are mandated to disclose by financial year-end 31st December 2025. The third question is there any specific standard or framework preferred for assurance? As stipulated, the recognized assurance standards are the International Standard on Assurance Engagements, known as the ISAE 3000 or ISO, which stands for the International Organization for Standardization. Lastly, there were also concerns about whether the internal assurance be done by other departments besides the internal audit department. As stipulated under the listing requirement, if a listed issuer subjects its sustainability statement to an internal review, it should be conducted by its internal auditor. As we conclude, let's summarize the key takeaways from each section. It is important to recognize the significance of both internal and independent assurance in enhancing the credibility of a listed issuer's sustainability disclosures. Whether a listed issuer has undertaken an assurance process or not, this must be disclosed in its sustainability statement to promote transparency. We strongly encourage listed issuers to carefully consider and disclose the details of the assurance process undertaken and its outcomes in their statements. This should include the type of assurance, subject matter, and the scope of the assurance process. By integrating assurance, listed issuers can strengthen their commitment to sustainability and at the same time ensure compliance with Bursa requirements. Thank you for joining us for Chapter 7 of our Sustainability Explainer. Stay tuned for the last chapter where we will cover TCFD-aligned disclosures. Welcome to the final chapter, which is Chapter 8 on Task Force on Climate-Related Financial Disclosures, TCFD-aligned disclosures. In this section, we'll explore the critical role of climate-related disclosures and their increasing importance in today's business landscape. As the world grapples with the impacts of climate change, companies are expected to integrate climate considerations into their overall risk management and business strategies. This is usually conducted through risk assessments, scenario analyses, and implementation of measures to address both physical and transition risks, all of which must now be disclosed in addition to your sustainability disclosures. However, there are differences in the expectations for disclosures between main market listed issuers and ACE market listed corporations. Let's dive deeper into that now. For main market, adherence to the TCFD recommendations involves disclosing all four pillars: governance, strategy, risk management, and metrics and targets in a dedicated section within the listed issuer's sustainability statement. Let's start with governance. Listed issuers are encouraged to describe their governance approach to climate-related risks and opportunities. This includes insights into the board's role in overseeing these factors, the involvement of management, and any stakeholder engagement processes. Moving on to strategy, where listed issuers are prompted to examine the present and potential impacts of climate-related risks and opportunities on their businesses. This is where listed issuers should explore how resilience is built into their strategies, adapting to various climate scenarios. The third pillar takes us into risk management, a critical aspect of navigating climate-related challenges. Listed issuers should detail their processes for identifying, assessing, and mitigating these risks. This includes seamlessly integrating climate-related risks into the broader risk management framework. Lastly, metrics and targets. Under this pillar, listed issuers should quantify their efforts, including metrics used to evaluate climate-related risks and opportunities, such as a breakdown of greenhouse gas emissions. Listed issuers are also expected to disclose any target set to proactively manage these aspects, spanning both short and long-term horizons. As we conclude our exploration of TCFD's 4 pillars, remember that this framework is designed to enhance transparency and consistency in disclosing climate-related financial information. Shifting our focus to the ACE market, listed corporations are required to disclose a transition plan as recommended by the TCFD. A transition plan is an aspect of a listed issuer's overall business strategy that lays out a set of targets and actions supporting its transition toward a low-carbon economy, including actions such as reducing its GHG emissions. In contrast to the main market, ACE market-listed corporations are expected to disclose only parts of the governance and strategy pillars outlined in the TCFD recommendations. More specifically, the disclosure must include the pivotal roles of the board and senior management in overseeing and executing the transition plan, along with their strategies and initiatives to mitigate climate-related risks and increase climate-related opportunities. The transition plan by ACE market-listed corporations must also be disclosed in a dedicated section within its sustainability statement. Now let's address the common challenge listed issuers may face in implementing climate-related disclosures. Contrary to the misconception of the need for a standalone TCFD report, listed issuers are only expected to include their climate-related disclosures in a dedicated section within their sustainability statement. However, to avoid duplication or overlapping of disclosures, cross-referencing to other sections of the sustainability statement is permissible. In cases where, for instance, the governance pillar in the TCFD recommendations overlaps with the general requirement for disclosure on governance structure, managing other sustainability matters, a listed issuer may cross-reference other relevant sections of the sustainability statement without needing to repeat the disclosures. The same principle applies to ACE market-listed corporations. Possible interlinks may exist between the strategies and initiatives to reduce climate-related risks and increase climate-related opportunities, and their management of sustainability matters. In such cases, cross-referencing can also be made. As shown on the screen, here is a way for companies to cross-reference their climate-related disclosures within the sustainability statement. As we conclude, let's summarize the key takeaways from each section. We encourage main market-listed issuers and ACE market-listed corporations to proactively embrace climate-related disclosures in alignment with TCFD recommendations. Main market-listed issuers should disclose the 4 main pillars outlined in TCFD recommendations, while ACE market-listed corporations are expected to disclose a basic transition plan. Bursa Malaysia believes that robust climate reporting leads to positive impact on stakeholder trust, investment decisions, and long-term business sustainability. We highly encourage listed issuers to integrate these practices, strengthening their commitment to sustainability and ensuring compliance. Thank you for joining us for Chapter 8 of our Sustainability Explainer video series. We have now reached the end of our series and we hope it has been insightful. For additional guidance, please refer to Bursa Sustain to explore our other publicly available resources, as mentioned throughout this series.